Hi everybody, today I'm going to share with you a household name company which is called Sheng Siong, and everyone know that they have benefit from the pandemic. As we start to open up the economy and start to live with the virus, would Sheng Siong able to continue to grow from here? This is what we're going to talk about today. Sheng Siong was established in 1985 and listed in 2011 and is been listed in Singapore for more than 10 years. It currently has 63 supermarket or store located around almost every corner of Singapore, plus another 3 supermarket in Kunming, China, and we are expecting the 4th one to be operational in China towards the end of the year. The latest result published in end October this year show that Sheng Siong have continued to record profit growth on a quarter by quarter basis, despite that they didn't have any new store open this year. We can see from this chart that the Sheng Siong growth is mainly driven by the number of supermarket stores they open in Singapore year on year. Thus, the key concern when I look at Sheng Siong is to look at how many stores can they continue to open going forward in the futures. And looking at the revenue trend, we can see that the revenue have been increased on a quarter by quarter basis. But do take note for Q2, last Q2 FY 2020, we can see that there is a huge surge in the revenue. This huge surge is mainly due to the circuit breaker where people rush the supermarket to stock up essential items, and this caused a huge surge in revenue. And these users were unlikely to repeat again going forward. And let's look at their profitability trend. We can look at their gross profit margin is pretty stable, hover around 27%, despite whether there is a surge in revenue or there's a normalized in revenue. It still maintained at a healthy profit margin of 27%. And their operating profit margin have actually improved during the pandemic period. One thing I like about Sheng Siong is their strong balance sheet. From this chart, you can see that their current assets have more than 50% are cash. This may be because that what they do, their sales transactions are mainly cash transactions. This resulted them in holding a lot of cash. And we can see that the earnings per share have been growing year on year before the pandemic. And however, due to the pandemic for FY 2020, we can see that is a huge surge in earnings per share, and the dividend per share also have a huge surge. So do be prepared that they may have a drop in earnings per share and dividend per share going forward in FY 2021 or FY 2022, where we have started to live normally. However, if they are still higher than FY 2019 before the pandemic, it is still pretty healthy. We can look at their dividend payout ratio is maintained at 70%. So it is pretty stable for Sheng Siong to just maintain these dividend payout ratios. And I think that is indirectly their unwritten rule of dividend policy, where they have constantly tried to maintain 70% payout ratios. From this chart, we can see that Sheng Siong since IPO have actually from 31 cents have started to grow to a all-time high of $1.86. That is on the peak of the pandemic, and currently it hover around 140 to 151 cents. From this chart, we can see that they are clearly benefit from the pandemic, and when we know that the economy start to open up, we can start to see there is a price weakness of Sheng Siong and the share price has started to come down. However, before the pandemic, we can see that the ROE of Sheng Siong is on an average of 25%, which is a very healthy ROE growth. And I will assume that their ROE will be able to continue to maintain at around 25% after the pandemic. Thus, I believe that Sheng Siong will still be able to continue to grow on that. Now let's look at how can Sheng Siong continue to grow from the pandemic. We know that they have benefited from the circuit breaker last year, and this year actually they will have also benefit from the spread of the virus. As we know that the Jurong Fishery Port have closed, the Pasir Panjang Wholesale Center have closed, and several spread of virus in the wet market, resulting in several wet market also have closed. And this has indirectly disrupted the fresh food supply. And however, Sheng Siong are able to avoid this disruption of fresh food supply by getting it from different sources. And because of the spread of virus in the wet market, people are also worried about going to wet market to do marketing. Such many of them went to the supermarket to buy fresh food. So this have benefited Sheng Siong this year on their financial. On the negative side, Sheng Siong this year didn't have any new store open, as we know that their growth is mainly due to getting more store to open. So for 2022, we know that we are opening up and there will be more, as long as HDB continue to build more HDB estate around in Singapore and calling for more and more tender of supermarket in the HDB estate. And hopefully Sheng Siong are able to win some of the tender and continue to expand their presence in Singapore by getting more store. I believe that Sheng Siong growth story will able to continue. Another part is they need to improve their store sales and enhance their margin of their store in Singapore. Although their China supermarket are profitable, however, kindly do take note they only have 3, with the 4th one going to open at the end of the year. The total contribution from the store in China is less than 2% of Sheng Siong revenue. Thus, we were not able to expect there will be a significant contribution on the China side to Sheng Siong bottom line in the near term. In a nutshell, I'm still very positive on Sheng Siong growth stories, as we know that there will be more housing estate being built in Singapore and they'll have more tender of supermarket coming forward. However, in the near term, we should be able to expect a normalize on their earning per share and dividend per share when the market start to open up. Please do not be alarmed when you see a dip in Sheng Siong earning per share or dividend per share in the next 1 to 2 financial year when the economy start to normalize. That's all I have to share with you today, and if you feel that you have benefit from this video, do remember to like and share, and also do leave your comment below to let me know what you think. Do remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.